is in the midst of economic crisis, when you wake up in the morning, to get a sense of where the crisis is, and obviously you look at various indicators, but do you look at a volatility index first? Do you look at the spread on bonds? Do you look at currency fluctuations? What for you, and for the audience, you can instruct us all, what for you are the key indicators that tell you that, boy, this is going to be another difficult day?
One of the problems of crises is in every crisis there's some other variable that turns out to be critical. At the moment, practically everything you mentioned is something we look at, certainly at spreads on, say, Greek debt, Spanish debt, so forth, are obviously things we look at in the morning. We look at the price of volatility, the VIX index, and what it costs to get into those contracts, and of course we look at exchange rates and their volatility. So all those things are there. Fundamentally, they're indicators. You're looking for signs of weakness in some financial system or the other, in transporter flows, in situations within countries. And so whatever it is that gives you information in a particular crisis, that's what you look for. And the art of being a central banker, and I'm sure it's even more critical to investors, is there are so many indicators you can look at. You better try and be sure that you look at the correct ones, because you can't look at all of them.
Vikram, you and I, in one form or another, are both associated with Wall Street. We were joking at the Wall Street Journal that the image of Wall Street had been so badly affected by the crisis that maybe we should change the name of the Wall Street Journal. But where do you think that US financial regulation will end up? And will Wall Street, as the world has known it, be a very different place a decade from now?
Question, Robert. First, let me say it's an honor and a pleasure to be back in St. Petersburg on this bright, sunny day. Not only because it's one of the world's great cities, but it's also a symbol of Russia resurgent in the world economy, and we've been, at my bank, very proud to be part of that resurgence for a number of years, serving approximately 1 million clients here. I think the question of Wall Street and where it goes, what it looks like, is an important one, Robert. Equally, what happens on Wall Street does affect Main Street, and if the purpose of the financial system is to support the real economy, there is also an impact on growth that comes from it. And there, I know we are all focused on Washington and what's happening there right now, but we also have to look at what's happening with Basel, and I'll talk about that as well in a minute. You know that all the rules and regulations are still being debated in Washington as of now, but there are some principles that are becoming clear, and so some of these are in line with what Stanley Fischer just talked about. Let me just talk about what I think the principles are that are behind some of the regulation and the impact that that's going to have on Wall Street. First and foremost, there is a big thrust to make sure banks are banks, that they're focused on clients, and that they're not speculating with their capital. Secondly, there is a big thrust to make markets transparent. And part of that is seen through the derivatives legislations and making sure that they're cleared and settled centrally, but it goes beyond that in terms of disclosure and other forms of transparency in the markets. The third part is a need for a strong consumer authority to make sure the needs and the rights of the consumer are protected in the right way through good and bad parts of the cycle. The fourth, and Stanley talked about this, but there is a desire on the part of everybody, banks included, that we should end too big to fail. And that's likely to happen through having a strong systemic regulator, but also by having a set of rules as to how you unwind institutions if something happens that is bad. And of course, there are questions about compensation on Wall Street, and therefore there's a clear principle that we should have a merit-based compensation system that's clearly driven by long-term performance. And I guess finally, the final principle is one of the lessons we've all learned through this crisis is you can have a banking system and a non-bank banking system as well, sometimes referred to as shadow banking, and that you've got to have a level playing field across all the participants. But when you put it all together, and of course the rules and regulations and the precision is going to have an impact, but essentially the goal is to return the financial system back to where it should be, which is to support the real economy, to help lending, saving, investment, driving those things that can actually drive the growth. And I do believe Wall Street is likely to be very different as a result of that, not only in terms of the larger institutions, but I do believe there'll be a new type of institution that emerges to take on some of the responsibilities that come out of the changes in the regulation as well. But let me go to the second part. And of course, the goal of a strong financial system, it's the mirror image of the real system. It is to support strong growth, and it's to support what happens in the real economy. And I think that's where some of the things that Stanley Fischer just talked about, and Basel particularly, are important. Now, let me be clear, as a bank that had to do with cleaning up an over-leveraged situation with a large amount of credit risk, I've got no desire, I can't imagine anybody has a desire to live through what we've gone through. But sometimes there are instincts that come out that can lead to over-tightening at the expense of laying a foundation for lower growth and perhaps not as much employment. And that is the tension that is in the system. I think it's good tension. But having seen some of the things that are coming out of Basel, I do believe all of us have to work together. And we should be concerned that the requirements are calibrated correctly, calibrated to make sure that we don't somehow believe there's a choice between a safe banking system and economic growth. I think that's a false choice. The right choice is to find the right balance that actually drives both to be safe together and have a balanced system that can accommodate the needs of a growing economy, and we've got some work to do on that in Basel. Now, let me tell you, I believe that this is an important question because the real challenge that faces us is growth in the world, particularly in the developed world. We are fortunate to have a developing world that's growing well, but we do have a developed world which by our records suggests that has something like 1/3 too much debt. And it's hard to grow and balance that debt at the same time. And so we do require a new model of growth. And obviously that new model of growth requires the developed and the developing markets to work together. That is a symbiotic relationship. I think we grow better working together than separately. And some of the principles that Mr. President talked about are absolutely clear. We've got to keep our markets open for goods, services, and talent. We need public-private partnerships, and all of which are designed to unleash entrepreneurship. But again, we need the right financial system to drive that new level of growth. I've been a very firm proponent of strong regulatory reform. I think we're getting it. I think we're getting that reform in a way that the financial sector becomes a supporting actor in this play to the real economy. But I do believe, and I'm concerned, that coming out of Basel, that we have to calibrate the rules and regulations correctly so we do not fall into that false sense of security which is based on a very safe banking system, but having...
Stands to a point. Do you think that, well, people call it the Volcker rule, but I don't know that anyone actually now knows what precisely the Volcker rule is, including Paul Volcker, because it's been so debated and so turned around. But can, you run a big bank, a global bank, can a retail banking culture and an investment, particularly a sales and trading banking culture, coexist harmoniously in the one institution? Because aren't there so many contradictions? The salary contradictions, the gung-ho culture contradictions, and in the end the risk contradictions that are so overwhelming that cohabitation is not such a good idea?
You know, Robert, there are cultural questions within companies, but a lot of that is not necessarily generic. You can't say these things on average. They're specific to institutions, and those have to be addressed at those institutions where they feel there are these cultural conflicts. But let me go to the basics of banking. So you are a corporate bank, and the corporate bank needs to make loans to a corporation. We support a lot of the Russian companies that need loans here, but not only here, around the world. Some of them want us to make them loans in Africa, and we do that. We make loans in domestic African countries. Now, the problem for a bank is, okay, I just made this loan. Where am I going to get the money to make this loan from? How am I going to fund it? And all of a sudden, you find yourself in a place where you say, I better go get some deposits from retail clients to be able to get the money to turn around and make the loan. So the choice, which is to say there's a retail bank and a corporate bank, is somehow an artificial choice, because it is the retail deposits that come in that allow you actually to turn around and serve the corporate clients on the other side. So the question to me is less about retail versus corporate banking, but it really is more about what is the goal that you have as a bank. And I do believe that the purpose for banks is to help clients, and where we can all learn from some of the things that happened over the last 5-10 years is that proprietary trading became a part of what it meant to be a bank. And therefore, I interpret Volcker rule, and again, as you said, we should ask him how he interprets it, and we'll see how the U.S. Congress interprets it shortly. In real color, but the point is, to me, that the goal is to focus banks on serving clients. And if you have to serve clients correctly, it's hard to say serve this client and not that, because really managing a bank requires you to gather deposits from one place and put them to work as loans in another place. You are forced to have a universal banking model. So let's have those rules and regulations that control how you use capital, how you think about speculating or proprietary trading, and that's where regulators become really important.